Welcome back. Let's talk to Phillip Shaw. He's the chief economist at Investec. Phillip, very good morning to you.
Hi, morning.
Normally we talk about football, but we'll skip that one this week. So let's kick off with North Korea. Obviously, massive amount of headlines, a lot of tensions, risk off. Okay, is this just a blip?
Well, we don't know. And when we're looking at global risks, we've been assessing North Korea as the most uncertain part of the globe right now. And, that's partly because the country's developing nuclear technology, but also because it's a very closed regime. We don't know how they are likely to react to events, and almost anything could happen. But, what we appear to be looking at is North Korea taking a slightly softer line on global aggression and saying, well, we will look at what the States does first before we launch 4 intercontinental ballistic missiles in the waters looking towards Guam, which is, of course, US territory. So, our central view is, look, what North Korea wants to do is to ensure the survival of the regime, and that's why they're developing nuclear weapons capabilities. But no one can really be sure how the dynamics will play out. But certainly we've had an encouraging set of events over the last 24, 48 hours.
Markets hate uncertainty, and obviously there was a lot of uncertainty last week. How do you factor that in the big picture?
Well, what you need is a medium-term view on how things are going to pan out, what the risks are to that medium-term view, also with an idea of how short-term dynamics are going to play out, within that framework. Really, what you want to be doing is a longer-term view on investment, but of course, you want an idea of what the road is likely to be towards that goal.
Yeah, okay. Finally, obviously, the US market's pulled back. Okay, more record highs this year on the back of this? Is this an opportunity to buy, I guess?
Short term, probably, yeah. We're of the view that if you look at the various metrics on the US stock market, it's not cheap, but it's not particularly expensive if you believe that US growth remains solid and you're going to get a decent flow of corporate earnings growth. I think, one big fly in the ointment is that the Fed is likely to continue raising interest rates, but also more importantly, it's going to be paying back some of its QE. So in other words, it's going to be shrinking its balance sheet by not investing in some of the maturing bonds from its balance sheet. If you believe that QE was a big factor in supporting global markets, and here I don't just mean equity markets, to a certain extent bonds as well, then if the Fed is beginning to shrink its QE holdings, then that's going to be at least a force in the other direction. Now, which of the countervailing forces is going to be the greater is a key question. But we would tend to be a little bit cautious with that likely to start occurring in October this year, albeit relatively slowly at first.
Phillip, thank you very much indeed.